Hey everyone, welcome back to Crypto Tax Australia, the channel dedicated to helping Aussie investors stay on the right side of the ATO. If you're watching this in 2026, there is a lot happening in the world of crypto tax right now. And I'm not talking about the usual, remember to keep your records stuff. I'm talking about brand new bracket changes, a global surveillance framework that is literally coming online this financial year, new rules if you have super or assets over $3 million, and the ATO's most aggressive data matching program we've ever seen. So whether you're a casual hodler, a DeFi degen, or someone running a trading operation, this video covers exactly what has changed for the 2025-2026 financial year and what you need to do about it. Let's get into it. Let's start with something that directly affects every single crypto investor watching: the new income tax brackets for 2025 to 26. The Stage 3 tax cuts, which kicked in last financial year, have been locked in, and there's one key change that is genuinely great news for crypto investors sitting on gains. The 30% tax bracket now extends all the way up to $135,000 in taxable income. What this means in practice is that many investors can realize significant crypto gains and add them to their regular income without immediately jumping into the 37% or 45% brackets. Here's how the full bracket table looks for 2025-26. 0 to $18,200, tax-free threshold, 0%, 18,201 Kwan, $45,000, 19%, 45,001 Kwan, $135,000, 30%, 135,001 Kwan, $190,000, 37%, 190,001 plus, 45%, plus the Medicare levy of 2% on top of each bracket. And remember, your net capital gain from crypto is added on top of your other assessable income. So if you earn $80,000 from your job and make $40,000 in crypto gains, your total is $120,000, and you're still in the 30% bracket. That's a meaningful difference from where the old bracket sat. If you're a company operating a crypto business, you're looking at a flat 25% or 30% rate depending on your turnover, which for high earners can actually be more efficient than the individual rate. This is the big one that a lot of people missed, and it is genuinely significant. From the 2025-26 financial year onwards, individuals with total superannuation balances or total assets exceeding $3 million are now subject to a 15% tax on unrealized gains. Let me say that again because it's a bit wild. This is a tax on gains you haven't even realized yet. It doesn't matter if you haven't sold. If your SMSF or portfolio holds Bitcoin, Ethereum, or other digital assets and the value has gone up, you may owe tax on that paper profit. For most everyday Australians, this won't apply. The 3 million threshold puts it firmly in high net worth territory. But if you're using a self-managed super fund to invest in crypto, this is something you absolutely need to discuss with a specialist SMSF accountant right now. SMSFs investing in crypto are a growing trend in Australia, and this new rule creates a compliance layer that simply didn't exist before. Alright, this section is the one that I think will genuinely surprise a lot of people, because most Aussie crypto investors have no idea this is happening. It's called CARF, the Crypto Asset Reporting Framework, and it is an OECD-developed global standard for the automatic exchange of crypto tax data between countries. Here's how it works. Crypto exchanges and service providers will be required to collect information on their users' transactions and report it annually, not just to the ATO, but to tax authorities internationally. And the ATO will in turn receive data about Australian residents who are trading on overseas platforms. The Australian Treasury has confirmed that CARF reporting requirements are set to commence from 2026, with the first exchanges of data between the ATO and foreign tax authorities expected to begin by 2027. Australia has signed on alongside dozens of other countries to implement this framework. What does this mean for you? Basically, if you've been using offshore exchanges thinking the ATO can't see it, that window is closing fast. The ATO is about to receive a stream of international data it has never had before. The existing domestic data matching program already covers Australian exchanges. The ATO can collect transaction data going all the way back to 2014. CARF extends that visibility globally. And there's one more piece to this. Starting from 2026, the ATO's data matching program will begin generating pre-fill notifications in MyTax. That means you may open your tax return and already see a flag telling you the ATO has crypto data on you. This is not a warning. This is them telling you they already know. Another change that matters to you as an investor, not for your tax return directly, but for how you access the market. By mid-2026, every platform operating in Australia that lets you buy, sell, or swap crypto must hold both an Australian financial services license and a new digital asset platform approval. This comes from the 2025 Corporations Act amendments. On top of that, since March 2026, all exchanges must comply with the travel rule, which means any transaction of $1,000 AUD or more requires both the sender's and receiver's identities to be verified and tracked. This is overseen by AUSTRAC as part of Australia's anti-money laundering and counter-terrorism financing framework. Why does this matter for your taxes? Because these requirements mean that exchanges operating in Australia are now legally obligated to maintain extremely detailed records of every transaction, records that are increasingly being shared with the ATO. If you're using an unlicensed or offshore exchange to avoid these requirements, you need to be aware that CARF is plugging exactly that gap on the international side. Alright, with all those new developments out of the way, let me quickly run through the core framework that hasn't changed, because these fundamentals catch people out every single year. Number 1, crypto is still property, not currency. The ATO treats all crypto, Bitcoin, Ethereum, stablecoins, NFTs, DeFi tokens, as a capital gains tax asset. This single classification drives everything else. Number 2, CGT events are still broader than most people think. It's not just selling crypto for AUD. A taxable disposal includes trading one crypto for another. For example, swapping BTC for ETH is a disposal of BTC, spending crypto on goods or services, gifting crypto to someone else. Wrapping tokens. For example,
Every
BTC
one of these
to WBTC is likely
event.
a disposal providing liquidity to a DeFi pool. The ATO treats this as a disposal of the original tokens. Number 3, the 12-month CGT discount still applies. If you hold a crypto asset for more than 12 months before disposing of it, only 50% of the gain is taxable. This is one of the most powerful tax strategies available to Australian investors, and it's completely legal. Important note on this though, each leg of a swap is assessed independently. If you swap an asset 11 months after buying it, and then sell the new asset 2 months later, neither holding qualifies for the discount. The clock resets on each leg. Number 4, staking, mining, and DeFi rewards are still ordinary income at the AUD market value when received. They are taxable as income in the year you receive them, not when you sell. And when you do eventually sell those rewards, a second CGT event is triggered on any further appreciation. Number 5, record-keeping requirements remain at 5 years from the date you lodge. You need to track dates, AUD values at the time of every transaction, wallet addresses, and the purpose of each transaction. For the 2025-26 year, that means keeping records until at least 2031. Let's talk about what actually triggers scrutiny from the ATO this year, because it's more targeted than ever. First, undeclared crypto-to-crypto trades. This is still the number 1 mistake. Investors know to report when they cash out to AUD, but many completely ignore every BTC to ETH swap in their history. With data matching, the ATO cross-references exchange records against your return. Missing trades stick out. Second, wash sales. The ATO flagged this in 2022 and they haven't let it go. A wash sale is when you sell crypto to realize a loss, then immediately buy it back, purely to reduce your tax bill without actually changing your position. The ATO can and will disallow these losses if there's no genuine change in economic exposure. Third, DeFi activity without reporting. Providing liquidity, yield farming, staking across multiple protocols, this creates a trail of taxable events that many investors are still not capturing correctly. The ATO has specific guidance on DeFi now, and auditors know what to look for. Fourth, inconsistency between exchange data and your return. If the ATO's data matching program has your transaction history from an Australian exchange and it doesn't match what you've lodged, expect a letter. Penalties for undeclared income range from 25% to 75% of the tax shortfall, plus interest. Fifth, large deposits or withdrawals that don't match declared income. Banks and exchanges both report to the ATO. If you're cashing out significant amounts that aren't reflected in your tax return, that inconsistency will eventually surface. Quick but important. Here are the dates you need to know. Financial year, 1st July 2025 to 30th. June 2026. Self-lodgement deadline, 31. October 2026. Lodging through a registered tax agent. You have until 15th May 2027 record retention deadline for 2025 to 26 transactions, until at least 2031. My strong recommendation, don't wait until October. Start pulling your transaction history together now, especially if you've been active across multiple exchanges or DeFi protocols. The more complex your situation, the earlier you want to be working on this. All right, let's bring it all together. The 2025 to 26 financial year brings the most significant set of changes to the Australian crypto tax landscape we've seen in years. New tax brackets that benefit investors with moderate gains. A new 15% tax on unrealized gains for high-balance super and portfolios over $3 million. CARF going live, which means global exchange data is flowing to the ATO. New licensing requirements for exchanges, and the most sophisticated domestic data matching program the ATO has ever run. The message from the ATO is louder than ever. They know about your crypto, and they expect you to report it correctly. If you found this video useful, please hit like and subscribe. It genuinely helps this channel grow and means more Australians get access to this information. If you have questions about anything we covered today, drop them in the comments and I'll do my best to answer. And as always, this video is general information only and is not financial or tax advice. For advice specific to your situation, please speak with a registered tax professional. See you in the next one.